So should we start now? Roman, are you going to share the slides?
I think they are shared.
Okay, fantastic. Thank you. So give another minute for people to join in, and I think we're ready. So like I said, the biggest news in markets is inflation, not just inflation and its impact on the economy, but the expected reaction, the need for central banks to react sharply to bring inflation under control is causing quite a bit of stress in markets. Risk assets are falling. Stock markets have performed poorly. Really, all financial markets for the first time in many years have performed poorly in tandem. That's bonds, that's stocks, that's credit. Central banks are turning increasingly hawkish, and that's actually bringing even some questions as to whether a recession is in the horizon in the near term. So should we go to the first slide, Roman? The inflation spike is dominating the news flow worldwide. Inflation has jumped to levels last seen in the early 80s or even the late 70s across the G10 and also emerging market countries. Central bank targets for inflation, which in most countries are somewhere between 2 and 4%, are being completely, massively exceeded by the actual inflation experience that we're seeing. It is no longer tenable to argue that these spikes in inflation are due to supply chain, to temporary supply chain blockages. It's clear that there is an excess of demand over the ability of supply to meet that demand. And central banks as a reaction are turning increasingly hawkish. Every single central bank in the G10, with one conspicuous exception, we'll talk about that, is either aggressively hiking or has telegraphed that it's about to hike and will do so in a very aggressive way. Again, the one exception so far is the Bank of Japan. Is anyone's guess how long that will last. This sudden increase in rates worldwide has triggered a flight to safety. Stock markets have retreated worldwide. Again, while the numbers look ugly this year, we should all remember that this falls come on the back of sustained increases over many years, so that we haven't really given up a lot of gains. But nevertheless, the year-to-date numbers in terms of stock markets are not looking pretty. The cost of living crisis has led to the deterioration in some indicators in economic activity, particularly consumer confidence, where the combination of inflation and the inability of real wages to so far keep up with the price of living has brought some of the lowest consumer confidence number in many years. It has to be kept in mind that consumer confidence is not always the best of leading indicators, in that consumers sometimes tell consumer confidence pollsters one thing and then keep spending anyway. But so far that record low consumer confidence has not really translated yet into a collapse in consumer expenditures, but nevertheless bears watching. To summarize, the word transitory when it comes to describing inflation has been retired for good. Inflation expectations and wages, as we'll see, are starting to respond. We're starting to see the beginning of those second round effects that central banks are so afraid of. So we go to the next slide to talk a little further about this. All G10 central banks, again with one exception, are aggressively hiking. Some of them, in particular the European Central Bank stands out, have lagged, have delayed as much as they could the beginning of the rate hiking cycles. But even the European Central Bank is now promising hikes that are in the future that are in line with most of its G10 peers. The Bank of Japan has also not hiked rates, and it is the only major central bank that not only has not hiked rates, but actually is communicating to markets that it does not intend to do so in the near term. Whether or not it's able to maintain its promise remains to be seen. Inflation in Japan, although lagging the rest of the world, is also picking up. And the need for constant intervention to maintain this 0% rates in Japan is causing increasing market stress in Japan. But for now, all G10 central banks are hiking aggressively, except for the Bank of Japan. And as we will see, that's also being translated into a very weak Japanese yen. If we go to the next slide. The increase in inflation, by itself, is not necessarily this. The actual inflation spike has been with us for a while, and the stock markets and risk assets generally worldwide were able to take it in stress for quite some time, because inflation by itself is not enough to really trip asset markets and to scare investors. The question is, the second round effect of the second order effects of that inflation is what's causing this worldwide sell-off in risk assets. The inflation spike is causing central banks to sound increasingly hawkish, and partly as a result of this tightening policy, both actual and prospective. We've seen some slowdown in economic news worldwide. This is we have here is a very useful sign, which is a surprise index. It tells you this index tells you to what extent economic releases, economics news actually coming above or below economists' expectations, and we've seen that after a few months in which economic data tended to come in way above expectations, that has now reversed, and if anything, we're getting mild negative surprises in the data. This index is not this positive, but it does tell you that we are seeing the first indications of a worldwide economic slowdown as a result of this general tightening of financial conditions, which central banks have no choice but to carry out if they want to be able to bring inflation back towards target. So we go to the next slide. The response of currency markets to this general flight from risk, this flight into quality, this heightened economic concerns, has been to buy the dollars. The dollar is the best performing major currency, 9% higher year to date against a representative basket of currencies. The worst performing, again, the Japanese yen, because the Bank of Japan has resolutely maintained a dovish stance, even as all other major central banks in the world turn around 180 degrees. It is true, it is undeniable that the economic news flow in the world is weaker than it was a few months ago. We're generally more optimistic than the market about the prospect for recession. We think that the prospect that the recession is the fears of recession priced in the market are excessive. We still have a consumer with significant pent-up demand and piled-up savings from 2 years of pandemic, in which consumer incomes were maintained fairly well, but the consumer was not able or willing to spend that money. In addition to that, employment levels worldwide are still at record. Unemployment levels are at the low, both in the Eurozone and the US, the UK. We have not yet seen a rebound in unemployment anywhere else. A consumer that has both jobs and savings from which to draw is likely to outperform what are pretty dismal expectations, regardless of what the consumer confidence surveys are telling you. And as to the other leg of economic growth, which is investment, we still have negative real rates. The rates at which most corporations can borrow are way below inflation. Large public deficits, which nobody is even talking about reining in. So an environment that is quite supportive of aggregate demand. This is not, it's hard for us to see how we get to anything more than the most technical of recessions, maybe a quarter of 0% growth in an environment like this, but we shall see. If we go to the next slide. Emerging market currencies have lost ground. I will say that they have underperformed the dollar. They have not underperformed the dollar by any more than, say, the euro on G10 currencies. So emerging market currencies measured in any major currency other than the US dollar have actually done reasonably well, in spite of the sell-off in stock markets, which tends to be quite negative for EM. This time, I think that they are outperforming. Commodity-dependent currencies in particular, those of Latin America, have done fairly well in a context of inflation and concerns about access to commodities, and generally, at least up until the last couple of weeks, fast rise in commodity prices. Also, in this cycle, unlike past cycles, this cycle is a little bit different in that emerging market central banks actually led the hiking cycle. In all the central banks, first the US starts the cycle, and then emerging markets have no choice but to follow. In this case, they, if anything, started the hiking cycle before G10 countries, which means that a lot of them are starting to approach the end of the tightening cycle. Whereas inflation is on average higher in EM countries than it is in G10, there's still increasing signs that the inflation may have peaked in some of the major EM countries, and that as a consequence, central banks there may be able to call it to start maybe even a modest easing cycle earlier than G10 countries, which should be positive for EM currencies. We're still optimistic that most emerging market currencies will perform well. Commodity prices are high and rising. This is not a conjunctural, this is a structural background for commodities, in which follows many years of underinvestment and on the one hand, and exploding demand on the other. Relative to still very, very low G10 rates, many major emerging market currencies offer very attractive carry in the sense of interest rates that are much higher than those obtained in G10 countries. And macro fundamentals are stronger than in past hiking cycles. In particular, the levels of external debt in EM countries relative to the ability to service this debt are less bad than they were in past hiking cycles when emerging markets suffered. So overall, we're still positive in EM currencies. They have done quite well versus the euro in general. We expect them to now outperform against the dollar for the remainder of the year. And without further ado, I think I will pass on to Matthew.
Yes, thank you very much, Enrique, and thank you all very much for joining our webinar today. A quick note before we go on, we will have hopefully time for a few questions at the end of the presentation. So if you do have any questions as we go through the presentation, please feel free to pop those in the Q&A function on the Zoom app, and we'll get around to answering those at the end. Moving on now, we'll talk about something that has really dominated news flow and dominated concerns among investors for the best part of the last year now, and that is, of course, the significant overshoot that we're seeing in inflation globally, relative to both central bank targets and also expectations of both central bankers and economists. And this has done two things, as we mentioned. It's first of all led to an aggressive pace of interest rate hikes among central banks around the world. It's also, particularly recently, increased concerns that a possible slowdown in global growth could be on the way in the second half of the year, and potentially even recessions. And those two factors are really driving most, if not all, of the volatility in the foreign exchange market at the moment. As mentioned, inflation globally has continued to far exceed expectations of both central bankers and economists. The key sort of catchphrase that we heard from central bankers in 2021 was that this jump in inflation would be temporary and would be of a transitory nature, i.e. just driven by one-off factors that would ease and that price growth would return back to targets within a few months. That has, of course, not proved to be the case, and central bankers have been proved to look a little bit silly. Of course, they're not alone, though, because economists have continued to underestimate the extent of this inflation overshoot in the past few months. We look at, say, the US, for instance, the latest or the most recent headline inflation number. Economists have underestimated 11 out of the past 15 months, 3 in line, only 1 where they overestimated it. A decent barometer of this is Citigroup's inflation surprise indices. You can see from the chart on the right-hand side that these indices have continued to increase to record highs or multi-month highs across the board, particularly in the G10, but also in Latin America, Central and Eastern Europe, for instance. Even in Asia, where inflationary pressures have been a bit more muted, we are still seeing an inflation overshoot. It's worth noting here that any number above zero, i.e. any positive number, suggests that inflation data on the whole is coming in above expectations of economists. Any number below zero, clearly the numbers coming in below economists' expectations. We're seeing, without a doubt, a significant overshoot in inflation data relative to expectations, and we have been, well, for the best part of a year and a half now. A number of reasons as to why we are seeing this inflation overshoot. Of course, at the beginning of the pandemic period, or at least following the removal of the lockdown measures, we saw an unleashing in pent-up demand among consumers following a number of months in prolonged shutdowns or lockdowns. At the time of this unleashing in pent-up demand, it was very difficult for supply to keep up with that boom in demand, particularly in those industries and for those goods where stocks were slightly more difficult to replenish and took a more slightly gradual process, durable goods, for instance. And that's led to an imbalance between supply and demand, which initially led to that initial move higher in prices. This has been worsened in the last few months, particularly amid ongoing supply chain disruptions in China. We've seen authorities in China impose some of the strictest lockdown measures that we've seen during the entire pandemic period in the last few months and weeks, which has further exacerbated the supply chain issues, as of course has Russia's invasion of Ukraine, which has also, of course, had the impact of driving commodity prices significantly higher, particularly given the contribution of supply of energy stemming from Russia and the various tough sanctions imposed from the Western world on Russia's economy. And so that's led to a highly inflationary environment, and one where we're unlikely to see a return to target for some time. We can clearly see that inflation overshoot in this graph. This represents current inflation data, the headline inflation numbers relative to central bank targets. As you can see, all of the G10 nations or economic areas now have an inflation overshoot, where inflation is coming in higher than either the top band of the central bank estimates or the central bank target level. We're seeing significant inflation overshoots in most nations, particularly the US, EU, and UK, anywhere in excess of 6 or even 7%. But also in the likes of New Zealand, Canada, Sweden, for instance, we've been seeing inflation overshoots that have been unheard of. Certainly in the time that I've been covering markets, we've never been even remotely close to a situation where all of these central banks had overshoots in inflation. What that's done is, of course, we've seen central banks raise interest rates very aggressively in the past few months in order to try and rein in this rise in prices. And we're getting an acknowledgement among not just the major central banks, but also emerging markets, where we're seeing the same thing. We're getting an acknowledgement among policymakers that it's going to take some time for inflation to return back to target levels. Certainly don't expect that to happen this year for the most part, maybe not even next year. We're looking 2024 and beyond for returns of more normal levels of inflation. So this overshoot, this increase in price pressures is going to be something that continues to dominate news flows in financial markets for some time yet. But what about commodities? I'll hand over to Roman for these next couple of slides.
Thank you, Matthew. So commodity prices are still at a very high levels, although they have recently eased. We follow a number of commodity indicators, and here you can see on the right-hand side the CRB commodity price index. In early June, it was at a 350 level. It was an 11-year high. Right now, it's at around 320. So we have seen that throughout most of the year to date, the commodity prices have increased significantly. This has been a consequence of both the supply side factors, but also demand side factors. One of the key themes has been an increase in the energy prices. And this has been a result of both the inability to quickly increase production. That was a result of a lack of investments before COVID. Also, we have seen an energy shock that was a result of Russia's extensive and further aggression on Ukraine in 2022. We have seen Western countries sanctioning Russia, and the hostilities and the number of decisions that Russia took, effectively weaponizing the energy, and particularly the gas, have resulted in increase in prices. We also have seen a surge in demand because the economies worldwide have opened after a long period of COVID-related disruptions, lockdowns that have been with us throughout 2020 and 2021. And this has resulted in a significant push up on to the commodity pressures. Generally, although the index right now is somewhat below levels that we have seen in early July, this is not necessarily a good sign, because this is attributed to the worsening in sentiment and recession fears in large part. Also, obviously, the index is significantly higher compared to last year, and it will be likely in the upcoming months. So it is contributing to high levels of inflation. Let's move on to the next slide. So we saw some correction in crude prices. Early in the month, the Brent futures that we focus on were above $120 per barrel. They were close to the highs from shock in February. Right now, they are slightly lower. However, nobody would say that $150 per barrel is a low price of oil, and the prospects for it coming down significantly from current levels aren't expected, or at least this is not the main expectations, considering that demand still seems to be there, and the restrictions on productions, the energy shock that is a consequence of Russia's war in Ukraine, those things are still with us. And speaking of Russia, on the right-hand side, we can see the natural gas prices in the EU. And as I mentioned, Russia has weaponized energy exports, and they have done so again in recent months, effectively in cutting supplies or pausing supplies or threatening to cut or pause supplies to European countries, which has pushed up the forward prices for the commodity in Europe quite significantly. Right now, we are talking about levels last seen during the shock in March. And unfortunately, the trend in the gas prices at this point is the one that is going up, contrary to what's happening with the crude prices. And we expect that the elevated commodity prices will stay with us for a rather longer time period. We would likely need to see a significant period of downturn to bring the commodity prices down. Nonetheless, we are seeing a series of factors that are pushing out those commodity prices, and I focus on the energy. However, looking at the agricultural commodities, there is a myriad of factors that are pushing those up that are also related with the situation, with the weather situation. So unfortunately, this likely is the environment that will stay with us for the upcoming months. And the central banks have reacted to it to avoid the anchoring of inflation expectations, which could make the situation much worse. Nonetheless, they have to likely go further with tightening policy, and those cycles will, for the most part, continue in the future. Some of the central banks will have to start them and move relatively aggressively. This is, for instance, the European Central Bank that we expect to tighten policy in the second half of the year rather sharply. This will likely be one of the key themes in the second half of the year: central banks tightening cycles and also the inflation prints. The fact that right now we are seeing some easing in the commodity prices could be positive in the context of inflation. Nonetheless, this is something that likely will stay with us for a longer term. So right now I'll pass on to you guys.
Yes, thank you very much, Roman. And what as mentioned, one of the main talking points that we're seeing in markets as a result of this increase in prices worldwide is heightened fears about a possible slowdown in growth in the second half of the year and potential recessions, which is not only causing a cause for concern for investors, but also for central banks. It's given them a little bit of a headache as they try and rein in prices, but also support economies at the same time. Clearly, a number of downside risks to the outlook remain, particularly the rising cost of living and the sharp increase in global inflation. Interest rates are also going up, in most instances at a very aggressive pace, which is obviously generally a negative for growth. We're also seeing a number of global uncertainties, particularly the war in Ukraine, which has led to disruptions in supply chains, as well as having a detrimental impact on consumer and business sentiment. And also the recent lockdowns in China, which have again worsened supply chains and has led economists to significantly revise lower their growth forecasts for Asia's largest economy. So that has stoked fears that recessions could potentially be on the way in the second half of the year. And so far, actually, we've started seeing signs of a deterioration in global economic data that would potentially point to a slowdown. So far, the hard indicators of economic activity have, for the most part, have held up okay, although we are beginning to see signs of a downtrend in the soft indicators, the sentiment indicators of business activity or consumer sentiment. The business activity PMIs have eased, as we'll get to in the next slide, and only just remain above the level of 50, which represents growth, and on a little bit of a worrying sign of a downtrend. Not in recessionary territory just yet, but it's something that the market is keeping very close tabs on. We've also seen a deterioration in consumer confidence. Many of the consumer sentiment indices have fallen even to multi-month, multi-year, or even record lows amid the increase in inflation, which tends to be a barometer that indicates a slowdown in consumer spending, maybe on the way in the next few months. And as a result, we've seen a number of central banks, indeed most of the major central banks, have revised lower their growth forecasts in recent months and weeks in response to this increase in inflationary pressures. And that's going to be the main cause for concern for central bankers as we go into the second half of this year. The PMI indicators, the business activity PMIs, these, as I said, have shown signs of a deterioration. These are one of the key indicators we look at when determining growth levels among economies. They provide a much more timely, up-to-date indicator and barometer as to how economies are performing than the GDP figures, which are released on a quarterly basis and run on a bit of a lag. These PMIs are released in the third or fourth week of the month for that month. So they provide a quick snapshot as to how if the services and manufacturing sectors are performing. This represents the composite index for the G3 countries. The composite index is a sort of weighted average of both services and manufacturing. We can see that these numbers still remain above the level of 50, so that any number above 50 represents expansion in that sector relative to the previous month. Any level below is contraction in that sector. So still above the level of 50, but we are seeing a downtrend, not just yet to levels that would suggest a recession is imminent, but it is a worrying sign nonetheless. We're seeing components of these indices, such as the business expectations components, for instance, falling to lowest levels since the COVID-19 pandemic first began, which is an indicator that perhaps we could see a continuation of this downtrend in future months. And that's causing a bit of a concern for investors. And it's not just been isolated to the major economic areas. We're also seeing a similar trend elsewhere, particularly in the likes of Central and Eastern Europe, where sentiment has been worsened, of course, due to the fallout of Russia's invasion of Ukraine and the ongoing war that we're seeing in Ukraine. Another good indicator that we tend to look at when trying to get a gauge as to future consumer spending is the consumer confidence indices. Similarly to the PMIs, we've seen a deterioration in these indices in the last few months, which potentially points to a possible slowdown in consumer spending in the second half of this year. When these indices are high, that tends to indicate that consumers are willing to borrow more, they're willing to spend more. It tends to be good for growth. When these indices are low, consumers borrow less generally, they spend less, and they save more, and then the economy tends to underperform. And what we're seeing is a pretty worrying downtrend in these numbers. We're seeing, in the case of the Eurozone, numbers around where they were at the start of the COVID pandemic at the beginning of 2020. In the UK, this number has actually fallen to its lowest level on record, and below levels that we saw at the beginning of the pandemic. It's holding up slightly better in the US, although we're still at sort of 16 months lows in the data. So again, a sign that we could see a deterioration perhaps in consumer spending activity in the second half of the year, and that consumers themselves are perhaps slightly wary that a recession or at least a slowdown in growth could be on the cards in the next few months. And it's not just the soft indicators of activities that have deteriorated. We have started seeing some signs that some of the hard indicators of activity as well have begun to worsen. Taking the US for an example, we've seen a worsening in housing data. New home sales, in particular in the US, have deteriorated sharply. The latest retail sales data significantly undershot economists' expectations, actually contracted month on month for the first time in a little while. And it's a trend that we're witnessing mostly across the board, and particularly among the major nations, where data is coming in slightly weaker than expectations as a result of this disproportionate impact of rising prices. A good gauge of that would be Citibank's Economic Surprise Index, which we showed earlier. This is for the US in particular. We can see that clearly we've turned into negative territory, which means that economic data, for the most part, is undershooting economists' expectations far more often than it is exceeding them, as data continues to show that perhaps activity is slowing more than the market had expected. As you can see, that's coincided with a downturn in equities. This is the S&P 500 index, which has fallen by almost 20% since the start of the year, primarily amid fears of rising prices and expectations that we could see a slowdown in growth and possible recessions later this year. The big question now, though, is are we going to see possible recessions, or is this merely signs that a slowdown is on the way? We would err towards the side of simply the economy is slowing, rather than necessarily we're heading for technical recessions. I think there's plenty of downside risks to the growth outlook that make a slowdown in growth inevitable. But as Enrique mentioned at the beginning, we're of the view that technical recessions, which is 2 consecutive quarters of negative economic growth, we think that those are avoidable. A number of reasons as to why we think that's the case. First and foremost, we think that the labour markets are extremely strong and tight, and we'll talk about in the next slide, which we think should help support consumer spending, particularly given low levels of unemployment, high net job creation, and increases in nominal wages. We also think that households have accumulated a vast amount of savings during the pandemic period, which again should help support consumer spending. In the case of the European Union, for instance, during the pandemic period, around 7%, it's estimated 7% of the EU's GDP was actually saved and was accumulated in excess savings during the pandemic period. So we think that should provide a little bit of a buffer, as should an element of pent-up demand still present in economies, and we think that that's being underestimated by markets at the moment, particularly given that we have sort of many people that still are yet to go on holiday since the pandemic, for instance, or yet to return to the cinema or theatres, and still we think have an element of wanting to make up for lost time during that because of the pandemic period, and won't be necessarily totally put off as a result of this increase in inflation. We're also seeing government support packages which have been targeted to support those most at risk of suffering as a result of the increase in prices, whether that be sort of handouts to households in order to help pay for energy bills, or increase in tax rates, for instance, we've seen in the likes of the Netherlands on energy, on good energy and the energy sector. We think that should also help households weather the storm of this increase in prices. As far as the labour markets are concerned, we think they're in very strong positions. We'll take the US as an example. We're seeing near 6-decade low unemployment, 3.6%. Job creation remains healthy. The net or the non-farm payrolls numbers have eased in the last few months or so, although still remain at very strong levels, particularly compared to pre-COVID levels, around about 408,000 for the 3-month moving average. Generally, pre-COVID, we said that around about half that, 200,000 would be a strong number. So we're still at very strong levels of job creation. Initial jobless claims have ticked up slightly, although again, you can see from the chart on the bottom right, we're still at very, very low levels and actually not too far above 50-year lows. And also, job openings are high, as are quits. These tend to be an indicator that, first of all, businesses are in a strong enough position that they wish to hire more staff, which is a positive sign for the economy. And also, the workforce is confident in the strength of the economy and the labour market in order to move around positions. So lots of reasons to be positive for the labour market, which, as I said, we think should prevent economies entering into technical recessions. So generally, as we said, we are more optimistic than the market when it comes to the global economy this year. We think that slowdown fears are justified, but slightly overdone, and we think that technical recessions can be avoided. If that was to be the case, this provides a very positive environment for risk sentiment and risk currencies. In that environment, we think that emerging market currencies would be particularly well placed to benefit, while safe havens, particularly the US dollar, which has outperformed so far this year, could potentially underperform, given that the market is pricing in quite a high chance that we do get some pretty significant downturns this year. Having said that, we have tempered this view slightly since our last update, since our last webinar. That is in response to the heightened risks that we are seeing facing the global economy, particularly the sharp increase in rates worldwide and this sharp jump in inflation, which has continued to exceed economists' expectations. But what about the central banks? I'm going to pass over to Enrique now, who's going to talk about how central banks have responded. Sorry, Enrique, you're still on mute, I'm afraid.
Sorry about that. And by the way, another piece of good news, the technical difficulties were solved and the video is working now, so that's good. Well, central banks actually seem to be in agreement with our stance. They seem to be much less concerned about the possibility of recession than most market participants are. And you're seeing that in these aggressive hikes that we're seeing from every G10 central bank, again, with the exception of the Bank of Japan. 8 of the G10 central banks have hiked interest rates. The laggard is the European Central Bank, will start next month and has made it clear that it intends to make up for lost time by hiking much more aggressively than the markets were expecting it to just a couple of months ago. The Federal Reserve leading the way with first in decades 75 basis point hike in June. The Bank of England also 25 basis point hike in June, 5 in a row now, and more importantly, a turn to the hawkish side after what had been fairly muddled and confusing communications from the Bank of England. Now he has joined his peers in saying that inflation takes front and center, and that rates are going to go up for the foreseeable future. The Swiss National Bank delivered a very shocking 50 basis point rate increase in June when no one was expecting it. In addition to that, it said that it would allow the currency to appreciate, which it has done. The RBA, the Reserve Bank of Australia, the Reserve Bank of New Zealand, both hiking by 50 basis points at the most recent meetings, both of them telegraphing at least 200 basis points of additional tightening. Also 50 basis points from the Bank of Canada. ECB lagging, but still set to raise rates in July. BOJ, Bank of Japan, the only one behind. It remains to be seen how long it can keep its easing stance as the one odd man out among G10 bankers. It's important to emphasize that though these are clearly very sharp moves, probably in terms of coordination and size and speed of tightening, we may be close to the fastest tightening of rates ever, but let's keep in mind that this is coming off extremely accommodative conditions, rates that were either zero or negative across the G10, and that in absolute terms, current levels of official rates are still very, very low relative to any area in the past, except for the decade of the teens. The BOJ, again, is the only laggard. Inflation there has been lagging in Japan because of idiosyncrasies of the way the Japanese corporations and workers react to price increases. But even there, inflation is also rising, and we don't know how long the Bank of Japan can keep up this ultra stimulative stance. So if you go to the next slide. The Federal Reserve has, as it usually does, has led the way with this in this hiking cycle, at least among G10 bankers. It raised rates by 75 basis points to the 1.5 to 1.75% rate in June. Let's not forget that just a few short months ago we were still at zero. The vote was unanimous. There was only one dissenter, and even the dissenter wanted a 50 basis point hike. This transmitted to the market, I think, what the Fed wanted to transmit to the market, which is that the Fed's priority is controlling inflation and is willing to take some chances, some risks in terms of doing harm to the economy and to asset markets, if that's the price that it has to pay to control inflation. Chair Powell indicated that there may be another 75 basis point hike in July, but he also tried to disabuse the market of the notion that this will be common. Again, The 75 basis point hike that we saw was predicated on the unpleasant positive surprise in inflation, the unpleasantly high surprise in inflation of the month on the week prior to the meeting. If we do not see further surprises in inflation, it's unlikely that we'll see more 75 basis points. In addition to this, the shock move, the central bank also revised its inflation forecast nearly a full point from 4.3% to 5.2%, and also revised growth down 2.8 from 2.8 to 1.7. That tells you that if he was willing to hike this much, in spite of revising its own expectation of growth, is trying to transmit the markets that the priority here is controlling inflation, not supporting growth. If we go to the next slide. The dot plot got a significant upgrade. If you can see from the blue line, the dotted blue line was where Fed participants had expected to see federal funds rate at the end of each of the following years. You see the massive jump. Now every single participant pretty much expect to see rates above 3% by the end of 2022. The vast majority spend those rates to stay between 3 and 3.5%. And there's a significant minority with which we actually would concur that expects rates to peak at some point somewhere near 4% by the end of next year. This is one of the largest upgrades in the median dot plot that we have ever seen. In fact, I don't remember such a sharp move between the consecutive meetings dot plots in my 25 years of following the Fed. That's another indication of how serious the Fed is and how concerned it is about inflationary pressures. If we go to the next slide. Markets are currently pricing in almost 2 full points of hikes from the Fed through year end, bringing the rate up to not far below 4%. Again, while 4% is nothing special in historical terms, we have been here and higher before. We have never gone up so far so fast because let's not forget that we were just a few short months ago, we were hovering near 0%. Our base case is still for that 50 basis point rate hike in July because we do not expect the inflation numbers between now and then to significantly surprise to the upside like the previous ones in May did. This would be a little bit disappointing for the US dollar because the markets are pricing more than that. Again, 75 basis point move is entirely possible. However, the market is discounting it as a near certainty, and we think that we may be close to the top of inflation, and we do not expect any further upside surprises in inflation. What we need to sustain this 75 basis point moves is not just high inflation, but inflation that continues to surprise economies and strategies, and that's a very high threshold. The next key number that we see to validate or not our view is the PCE inflation numbers Thursday. Those are the unlike the CPI inflation, which is the ones that get more press. The consumer expenditure numbers are the ones that go into the GDP numbers, and the Federal Reserve pays more attention to them. If we start seeing not a pullback of inflation, but at least a flattening out and moderation of those inflation pressures, this would be quite significant and may mean that the Fed no longer has to move in these frantic 75 basis point moves. Now, we still think that we're going to see 50 basis points every meeting for the foreseeable future. The only way that changes and we go back down to 25 basis points is if we see a clear sign of not just inflation not going up anymore, but inflation trending down, especially in the core indices, in a sustained manner. That's still, I think, quite a few months away. So we expect to see 50 basis points for the foreseeable future every meeting. Go to the next slide. Again, the dollar as one would expect in this cycle, in a combination of two factors, where the Fed is leading the European Central Bank and other G10 banks in the hiking process, at least so far, combined with bouts of risk aversion, money looking for safe havens. Traditionally, that's been the role of the US dollar and the Japanese yen and the Swiss franc in currency markets. The Japanese yen has become very unattractive because of this Bank of Japan being the odd man out and maintaining an ultra dovish stance. That leaves not many safe havens for people to fly to, and the US dollar is the most obvious one, and that's what investors are flocking to. In addition to that, we've had a significant increase in US bond yields, where the entire curve of Treasury bond yields is above 3% for the first time in many years. And in this global slowdown, in part because of its relative isolation from the impact of the Ukraine war, the US has been relatively resilient compared to other European economic areas, especially the euro. The combination of these factors means that the US dollar is near 20-year highs. So with that, I will pass on to Roman, who will explain to us where the European Central Bank is relative to the Fed.
Thank you, Enrique. So as you could see from the past slides, the Federal Reserve was very aggressive in tightening policy, particularly recently. The European Central Bank also changed its tack with regards to monetary policy quite significantly by stopping the QE program. Nonetheless, it still hasn't raised interest rates, but it is communicating to the market that it will do so in the upcoming months, and it will do so relatively aggressively. So the expected hike for July, which will start the cycle, is a 25 basis point increase based on what the ECB was communicating. Nonetheless, some members have recently, even in recent days, raised the possibility of a 50 basis point increase in July. Considering that this is only priced in only like 30 basis points out of those 50 are priced in. If we indeed were to get this surprise, then we would likely see a uptick in the euro. The larger hike, 50 basis point, is expected to take place in September. The markets have no doubt about it, and the European Central Bank has been quite explicit in suggesting that this may indeed be the case, barring a decline in inflation forecasts. But this right now looks very unlikely that we are going to see those inflation forecasts revised down. So I think that a 50 basis point hike in September can be viewed as something close to a certainty. So what is uncertain is the size of hike in July. The ECB's change of tone, a hawkish pivot, is a consequence of a broadening of price pressures. Also signs that the inflation expectations are above target, which the anchoring of inflation expectations is something that every central bank is worried about, because even in the favorable external environment, this could push inflation up. And this is something that the European Central Bank certainly doesn't want to see. And also in the last meeting in June, we had quite significant revisions to the inflation forecasts. Actually, if we go back to March, the European Central Bank outlined a few types of scenarios. And the new forecasts in June, if we take into account the combined 3 years of forecasted inflation, put it together, the new forecasts are worse than the worst forecast that the ECB had in March. So the situation deteriorated significantly in that regard, and is calling on the ECB to start the tightening process and to do so quite aggressively. Right now, I think there is a sense in the market that the ECB is late to the party, or as we say, is behind the curve. And because of that, those upcoming moves will be relatively significant. Let's move on to the next slide. However, the European Central Bank also has an issue because tightening policy is great for countering inflation, but this certainly isn't something favorable for economic growth. Obviously, this results in this works towards slowing economic growth, and this also leads to increasing costs of credit. And this is particularly an issue for heavily indebted countries. And in the EU, we have a number of heavily indebted countries, that have also suffered significantly during the COVID period, that saw recessions more significant than most other countries. And those are, for instance, countries of the periphery in Europe, in southern and western European countries, such as Italy, Spain, Portugal, and Greece. And those are the countries that have been hit also because of the lockdowns, which resulted in a significant decline in tourism. Nonetheless, those countries right now are seeing limited levels of economic activity, and also they are seeing a significant increase in the cost of debt, which is visible in increase in yields. The bond yields of those heavily indebted countries have risen more significantly than for countries in the core, such as Germany, and this has presented a risk that the European Central Bank will be slowing economic growth, or even pushing certain countries into a recession, the countries that have already issues with the economic situation and they're heavily indebted. So this has resulted in some fears in the markets, and the ECB needed to respond to those fears. So they have already addressed it during their meeting in June. And nonetheless, the markets were not satisfied with it. So a few days ago, they held an ad hoc meeting, which worked to calm the market and to actually to limit the spreads between countries such as Italy and Germany. And what the ECB will do is, for one, they will use the PEP reinvestments, so from the pandemic asset purchase programs, and they'll be skewed towards most indebted countries in the euro area, and which should work towards lower yields, or at least limit the increase. And also they are working on an anti-fragmentation tool, which should work towards closing the spread. Although both targets of the central bank, which is to lower inflation and also not allow the yields in the countries of periphery to increase too much, are contradictory, right now the markets seem to be relatively optimistic that this goal will be achieved. And we recently saw a closing in the gap, or between the periphery and the core. So it's not as bad as it was a few months ago. So a few weeks ago. Let's move on to the next slide. And right now, what we are seeing in the euro-dollar rate is, I think, stability. For the past few weeks, the currency didn't move much. The euro has fell to the 20-year low in mid-June, although right now it's stabilizing at approximately 106 rate, 105, 106. We are optimistic that the euro-dollar will be able to gain in the coming quarters. Nonetheless, there is a number of risks to the currency that we also need to mention. One of the risks is the slow response of the ECB to raise rates. Many global central banks, also in the G10, have engaged in a very aggressive tightening cycle. The most clear example here is the Federal Reserve, and the European Central Bank was not willing to raise rates, so we can't be sure how fast will they move going forward. Ongoing energy crisis in Europe. As I mentioned, the gas is used as a weapon by Russia, and this has resulted in uptick in gas prices, even though the crude prices have declined. So we are there is another risk that could negatively impact economic growth and also support higher inflation, and also fragmentation in bond market. This is something that has resulted on a number of occasions in the sell-off of the euro. And if the market feel that the ECB did not address this issue enough, then we may see a worsening of sentiment in that regard. Also, growth risk associated with Russia-Ukraine war is ongoing, and unfortunately, right now it doesn't seem to be nowhere near ending. So this is clearly affecting the sentiment. This is also leading to a lot of supply side issues with transporting grain, with a number of other. And generally, the war has already contributed negatively to economic situation and to the inflationary picture, and we cannot be certain that that the effect will not be with us for some time. But right now, I'll pass on to Matthew.
Yes, thank you very much, Raymond. We're a little bit over time at the moment, so I'm going to skip through these last few slides pretty quickly, and we can move on to questions. Just very briefly on the Bank of England and the BOE, as you've mentioned, raised interest rates by another 25 basis points. It's June meeting, it's just straight hike. So the MPC has delivered some rather muddled communications in the last few months, and we've been pretty critical on the Bank of England, more so than pretty much every other central bank in the last few months. But it appears to have taken a hawkish turn at its last meeting. Not only was the vote split with 3 members in favour of 50 basis point hike, but the MPC also changed its forward guidance with regards to future monetary policy moves. It switched its guidance to say from some degree of further tightening be required, which we thought was relatively vague, in favour of will act forcefully if needed. We think this is a very significant change. We think, as we've said earlier, this potentially tees up the possibility of larger rate hikes from the Bank of England in the next few months. So actually the MPC is now appears to be following many of its peers and looks as though it could be on course to raise rates by 50 basis point increments in the next few meetings. The pound actually initially sold off following the June meeting, although markets eventually came around to the view that this change in rhetoric was indeed hawkish, and that the MPC is now more concerned, or at least shifting its attention back towards inflation rather than worrying about the growth outlook. It's also mentioned the value of sterling in recent communications and effectively saying that a weaker pound had inflationary implications. We think that's another positive for sterling. We think that the Bank of England will potentially continue to talk up the value of the pound at the next meeting, while also raising rates at a larger increment. We expect a 50 basis point move in August and perhaps another one at the September meeting. Markets are actually only pricing in a 70% chance of a 50 basis point move in August and a 50% chance of 2 back-to-back 50 basis point hikes. So this could, we think, provide a little bit of upside for sterling, which, as we can see from the next slide, has struggled a little bit in the last few months. The pound has been languishing around the sort of 120, 125 range so far this month. A number of reasons why that's the case. First of all, we've seen heightened recession fears in the UK, particularly given the significant overshoot we've seen in UK inflation. As I said, communications from NBC members have been muddled, although we think that it has changed that for the better. The steady approach to tightening has also caused the Bank of England to lag behind some of its peers, although again, we think we're going to see an acceleration in the pace of hikes in the next few meetings. Should be positive for the pound. We've also seen a few political risks in the UK, particularly with regards to Boris Johnson's leadership, and also the possibility of a Scottish independence referendum, another one. We think those risks are slightly overdone, particularly with regards to the latter. Again, all our views we think point to a slightly stronger sterling, albeit we are revising our forecast slightly lower from our previous estimates. With regards to emerging markets, I'm going to quickly go over this slide before we go on to questions. What we have seen, as we've mentioned, is EM central banks raise rates at a very aggressive rate. And actually, they started hiking much sooner than their major peers, particularly given the massive overshoots we saw in inflation there. And even Asia has started to catch up in the pace of policy normalization. As we mentioned earlier, though, however, many are approaching the end of their tightening cycles and are actually now winding down the pace of rate hikes, or at least pausing for the next few months to assess data. We think that presents a little bit of downside risk to emerging market currencies, albeit our positive worldview means that we think that most are in a position to either hold their own against the dollar this year or appreciate in the next sort of 6 months or so. With all that out of the way, we'll have a few minutes for questions. As I said, we've overrun a little bit, but we do have a few questions that have come through already. The first of which was on euro dollar. Do we expect euro dollar to reach 115 this year, or keep decreasing? Today we're at 104 in euro dollar. So Enrique, what do you think? What are your views on euro dollar? Do you think we can get to 115?
I think that 115 this year may be a bit aggressive, but I do think that parity is very unlikely. I think that current levels already priced in an enormous amount of hiking from the Federal Reserve, combined with what is still relatively modest expectations for hikes out of the European Central Bank. And we're thinking, we're already seeing a pretty serious hawkish pivot on the part of President Lagarde and other council members. I think that still has some room to run. I think that once the markets become a little bit less pessimistic about the possibility of a European recession and start pricing in what we think is a more appropriate level of hikes from the European Central Bank, and the gap between the European Central Bank expectations and the Fed expectations narrows a bit, we could see a rebound in the euro. That is, I think, our view.
I agree. And yeah, thank you very much for your question. If you guys do have any more, please feel free to put them in the Q&A function. We'll hopefully get around to answering them.
There's actually an interesting question that I see here from anonymous attendee.
Yes.
Where it says, what do you mean by near future? When you talk about the Fed going up 50 basis points in every meeting, just wanted to understand, is it starting to change in 3 months, in 6 months, in a year? I mean, that's a difficult question. I think that given the typical lags of monetary policy of 12 to 18 months, I think that in this case, given how sharp the tightening of financial conditions has been, for instance, in the US, the typical 30-year mortgage rate is now around 6% from below 3% 12 months ago. That's an unprecedented level of tightening. I think that probably we're closer to the 12-month lag between, monetary policies getting a move on and inflation starting to trend down. So my guess is by the end of the year, we will see hopefully some trending down in inflation. It's still very high, but at least clearly trending down. And so we will see 50 basis points a meeting for the remainder of the year, and perhaps the Fed can ease a little bit into 2023. But it's very uncertain at this stage.
Great.
Yeah, there's also another question about the euro dollar to go below 1. I think we responded to it, although with regards to that, I think the biggest risk in my view is that if we were to get a further energy crisis, yes, gas disruptions, things like that, I don't think that monetary policy will be an issue. I don't think that the European Central Bank will get cold feet. I think that they have enough signs to tighten monetary policy. And if anything, I would think that the risk is to the upside versus what the market is expecting, even in the short term. But the gas disruptions may happen, and so this, in my view, is the biggest risk. And then I think the question would be for Matthew. What do we think about the sterling dollar? Will it go below 120?
Yes, well, I think this is, we talk about euro dollar and parity. I think that's a very significant barrier for the pair to breach. We've been talking about euro-dollar parity, for the last sort of 8 years, and it's not come to fruition. When it comes to sterling dollar and 120, well, that's a much easier barrier to be broken. It's not necessarily as significant, it's nowhere near as significant a psychological barrier. So if we do continue to see signs of perhaps the Bank of England a little bit more on the dovish side relative to its peers, if we do start seeing more of a deterioration in UK data, if perhaps talk of an independence referendum in Scotland continues to hit the newswires, then no doubt we could see a short-term move below 120. But we actually think that at these levels, sterling is very undervalued. We think that the Bank of England will exceed market expectations in the second half of the year. We think UK recession concerns are overdone, particularly given the strength of the UK labour market. So actually our long-term view is still for a higher value in sterling against the dollar, albeit, as I said earlier, we are going to revise lower that view in light of these rising recession risks. Great. I don't know if there's any more questions that any of you have at all that you'd like us to answer. If not, we are a little bit over time anyway, so I think that's a good place to wrap things up. So yeah, thank you all very much for joining our latest webinar. Look out for our next one. We'll try and do another one of these in another sort of 2 or 3 months' time. But thank you all very much for joining.
Thank you.
Thank you.
Thanks, everyone.